Hello, everyone. This is Daniel Neesmith with Security First Asset Management. Shane is on here with me as well. Hope everybody's having a good morning. We're going to give folks just a couple more minutes to get logged on. We see there's several people joining us. For those of you that don't know us, we are a full-service financial advisory firm. We do income planning and retirement, portfolio management. We help all age groups. So we think everyone needs to have a financial plan and an income plan. So if you know folks, or if you in particular need help getting those things together, we're here to help you. So you can find out more information about us on our website, www.sfamga.com. And you can see our upcoming events and all kind of things on our website. Today we have an exciting topic for many people. You've mentioned and voiced your concerns about what may be happening with tax changes, with regulations, proposals. Most of these things are still hypothetical until Congress passes something. So we're going to talk about what may occur next year, some of the proposals that have happened, potential tax law changes by the Biden administration. So we're going to look at that and how that may impact you. And if you think that there's some steps that we can take with you, please reach out to us. But for most of our clients, we're already always thinking about what can we do to help reduce your tax liability. If you think like we do, we think people are already paying enough in taxes. So we work hard to make sure that we're keeping your taxes as low as possible. So a little reminder about an upcoming event here. Family Financial Workshop. That's going to be Thursday, September 23rd at 11:45 a.m. We've gone back to doing more over the internet events just because we've had several clients and friends of ours and family that have battled COVID. We really hope to be getting back next month to more in-person events. We took a little break from them, but Thursday, September 23rd, 11:45 a.m. We're going to be talking about Family Financial Workshop. And what that is what can your kids and grandkids, what can the younger generation do to start planning, start making sure that they have a financial plan in place? And it's really for all generations, though. So we're going to be talking about how important it is to stay out of debt. We're going to talk about how important it is to have a budget and how to plan for retirement. So those are going to be the topics that we cover. So as we go through the presentation today, Shane is going to be manning our question and answer over in our chat box. So please feel free to ask questions. She will answer your questions there. And this is also being recorded and will be shareable. So if you have friends that you think are concerned about what the future may hold in the U.S. here, what proposals may be likely coming next year, please share this presentation with them. We are happy to help them with their financial planning needs. All right, so with that being said, we're going to go ahead and get started. And as I've already mentioned, today's topic is retiring in Biden's America. Now, I want to get it out of the way. This is not a political conversation. These are just facts. These are facts about proposals that have been made, and there's new ones each day. So this is not likely exactly how everything will shake out, but it gives us an idea, a flavor of how they're thinking and what proposals are on the table. So we're going to talk about not only what changes may be coming and some potential solutions as well. So there's always things you can do to plan ahead, and we're going to talk about that. Of course, this is we're securities licensed. None of this is a solicitation for any product or investment. So the reason we're on here and the reason we do what we do is we believe people in all stages of life should plan to thrive, not just survive. So in order to thrive retirement, you need a plan. And unfortunately, only 10% of Americans have an income plan, a way to know how to get their income, where to take the income from, what kind of asset allocation they should have, how to reduce tax liability. Only 10% of Americans have that type of plan, and that's what we offer. So here's the question: should we be worried? Anytime I see a group of politicians together like this, I get worried. But let's talk about maybe some reasons not to worry so much. This is a graphic I've shown recently in some presentations over the last few years. Most of the time people think about politics really influencing markets. And luckily for us, they don't influence them as much as we might expect. This is information and data going all the way back to 1789 of the S&P 500, the Dow Jones Industrial Average. This is a conglomeration of all those and the returns on markets that we've seen under Republicans and Democrats, be it president or Congress. And on the far left, you can see the years of a presidential term. In the first year, returns of the markets generally aren't as high. But imagine that in the last 2 years of a term of the president, they do all kind of things to help stimulate the economy, to help boost returns. So returns are generally better under the second 2 years. But what we don't see is really, really bad returns under one party or the other. Right now, we're under a Democratic divided Congress. So that's the far right. So in the past, we've seen 14.5% returns under the first 2 years of a Democrat president, and Congress being divided. They don't have a supermajority, and a 10.9% return for the last 2 years. So don't be too pessimistic and don't tie your thinking to, well, if a president is a Democrat, the markets are going to crash and tank. What drives markets is profits. Corporate profits have been very strong post-pandemic. In fact, the first quarter of this year, the average company on the S&P 500 beat their earnings forecast by 30%. Second quarter, over 15%, and they still have strong outlooks moving forward. So don't get too tied up in thinking that the president's back there pulling the lever with, or the Congress is pulling the lever on corporate profits. If we're allowed to have a free market economy, we're going to see profits, and profits are what drives markets. We just suffered a deep recession last year. There's no reason to believe in the short term we're going to see another recession. Now, that being said, we could always have black swan events, things that happen out of the blue that we don't expect. So we're prepared for that. We have downside risk protection and risk-protected strategies for our clients in place. So let's talk about the 46th president. Down on the bottom right, you can see it says, warning, tax increase ahead. That's kind of a joke, but not really. The proposals that are on the table do look like higher taxes for us. So let's talk about some of these proposed changes. So first of all, you've heard about the corporate tax rate. So this isn't just for large companies. This is the corporate tax rate for small businesses as well. Depends on how they're structured, if they're a C Corp. But the current tax rate is 21% maximum. It will go up to 28%. Now, 21 is already some of the highest in the modern world, in the Western world. We will be much higher than Western Europe if we go to 28%. It certainly will not be good for the economy to do so. It simply takes money out of the private sector and moves it over to the government, who doesn't necessarily spend it in the most appropriate ways. Another change we're looking at that's been proposed is the marginal tax rate for income earners over $400,000. The current is 37%. That's the maximum. The maximum bracket you would be in today is 37%, no matter how much money you make. The proposed moving forward is 39.6%. Of course, that does not count the Obamacare tax. So in addition to that, it's close to 3% as well. Next, proposed tax changes for married filing jointly. So let's take a look at this. The current, if we look at the brackets here in the middle, as long as you're earning under $300,000, you're paying 24%, and you're likely not to pay more than 24% maximum tax bracket, marginal bracket for next year. But if you make over that, it could go up significantly. So if you make over $400,000, you would jump from 32 up to the 39.6% bracket in 2022, and instead of going from 32 to 35% this year. So substantial changes for income earners. Now, this also affects small business owners that are doing business as an S Corp. Of course, those are pass-through income taxes that go to them. And I should give the disclosure, I am not a CPA. We are simply giving you information about tax law changes and proposed changes and what may happen. So, of course, you always want to consult with your accountant or CPA before making any changes. So another proposed change for capital gains. This one really concerns me. Capital gains are investments that you hold that are not in IRAs. They can be in real estate. They can be in stocks. The current maximum you would pay on the sale of a long-term gain, that's anything you've held over 1 year, a year and a day, the max you would pay on that gain is 20%. So moving forward, if you have over $1 million with income, that also would count your sale of your long-term gain. If those added together are more than $1 million, it could go up to 39.6%. So this could stifle investment. This would be a very negative thing. I hope that they don't do this, of course, but this is something we're watching very closely. Long-term capital gain rates jumping up to 39.6% would not be something we would like to see. So capital gains rate, again, this year, the max you would pay is 20%. Next year, income over $1 million, it goes up to 39.6. So I think taxes are on sale today versus what they're going to be next year or the year after. And there's a strong case to be made for that. So if there's things you can do now, would be the time to do it. Don't procrastinate. This could be happening sooner than later. Another thing is they're going to limit itemized deductions for anyone in the 28% income bracket or higher. So let me give you an example. If you make $400,000, which is where the 28% bracket is currently, they would cap the amount of deductions you could get at 28% of your income. So you can see there, when it goes from the 24% to the 32% bracket under the proposed, it would cap the amount you can deduct at $11,200, which is 28% of $400,000. That would be the max you could deduct. Under the current law, it does not cap that out. You can keep going up and deduct. And so, that could stifle contributions to charity, for example. They're going to cap the amount you can deduct at 28% of your income if you have more than $400,000 in income. But a lot of folks that make that money, they are giving to charities. That this could slow that down. So I think that's a negative. So they're looking at phasing out small business income deductions with income earners over $400,000 as well. So there's some serious implications to what we're talking about. Now this to me is one of the largest things that have been proposed. Under current law, you get what's called a step up in cost basis if you inherit an asset that your family member owned. Let's say your mother or father owned a Coca-Cola stock and they paid $100,000 for that Coca-Cola stock, and now it was worth $300,000 on the day of their death. In the past, you would only owe taxes on $300,000 or above after you sold Coca-Cola. Under the proposed tax change, you would owe taxes back from when the stock was purchased. So you would owe taxes at the purchase price of that stock. Same for real estate. So you'd have to know the cost basis of that real estate. What really concerns me is, what if you inherit a family farm that's been in your family for a very long time? Under the proposed tax change, you would have to pay long-term capital gains when you sold the farm based on the purchase price of the original purchase. So this is something we're watching very closely. I really hope that doesn't end up in the final law. So that's something you're going to want to watch if they eliminate the step up in cost basis. Okay, so here's another big shock. Currently, what we call the estate tax, individuals have a $11.7 million exemption per individual. So a married couple, each person gets $11.7 million exempt from estate tax. So if you go over that, it's 50% tax on that. The proposed change drops that down to $3.5 million per individual, or $7 million per couple. But then as the second spouse passes away, if they're over, if they're single when they pass away and they have a $3.5 million deduction and they pass on a $7 million estate, it's all going to be subject to the 50% estate tax. So there's going to be a lot of scrambling to put things in trust to reduce some of those possible tax changes if that law goes through. So this is another big deal, the reduction of the estate tax exemption. Now, I agree very much with both of these statements. The hardest thing to understand in the world is the income tax. That's what Albert Einstein said, and he's supposedly one of the smartest humans to ever live. Will Rogers said the difference between death and taxes is death doesn't get worse every time Congress meets. I agree. So we're really watching closely to see how much worse it gets. Hopefully, we don't see dramatic and prolonged tax increases, but we know some are coming. Here's what we've seen, the results of this. This is from a nonpartisan group that calculated the results. It would reduce GDP by 0.4%. Stock prices would drop, wage rates could drop if all the proposals were enacted. Full-time jobs, 64,000 would be lost on day one. So there's a lot of negative impacts to the economy if this all goes through. Now, historically, we don't see this type of legislation all get passed. There's still some moderate holdouts in Congress that would not get reelected if they raise taxes to these degrees on their constituents. So we don't anticipate all of these things going through, but certainly some of them. So that being said, there's some proactive measures you can take to reduce it. So here's what we can do. Instead of being reactive and saying, well, we'll deal with that when it happens, it may be too late at that point. We believe in being proactive with your tax planning approach. One thing you can do and should be doing, especially if you're younger, is contributing to a Roth IRA first and foremost. Don't defer all your taxes and tax deferred plans into the future because you may have a higher tax rate when you retire. So we're big on Roth conversions under many circumstances. Here's some of the things you should know, some critical factors. The tax rate differential. All right, what's the tax rate versus today versus your future withdrawal years? If your current rate today is 15%, but it may be higher than that in the future, why are you deferring your taxes? You can use outside money to pay the tax liability. So if you do a Roth conversion and you have some money sitting in the bank earning zero, you could pay the tax with that money. You have to consider whether or not your IRA distributions you're taking are needed to meet your annual living expenses. Those distributions cannot count for a Roth IRA conversion. You have to look at your time horizon. The longer we can spread out the Roth conversion, the better. For some people, we have to look at the estate tax, not for very many. And then the new 10-year rule. If you have inherited a non-spousal IRA, you have to have withdrawn those funds. If this person passed away in 2020 or 2021, you have a 10-year window to get the money out of the IRA if you inherited an IRA from non-spouse. So those distributions could not be rolled into a Roth IRA, nor can required minimum distributions be rolled into a Roth IRA. Outside of that, we look at what the best bracket to do so is. So you see two different ladders here. The top ladder is what the tax law is going to revert to in 2026 when the Tax Cut and Jobs Act expires. So the black brackets on the bottom is where we're at currently. So you can see in 2026, the 12% bracket reverts to 15, the 22% bracket reverts to 25, the 24% bracket goes up to 28, so on and so forth. So we see that taxes are objectively on sale if this is what happens. We know that today's rates are lower than what they're going to be in 2026. So what that means is we should figure out which assets and how much you should convert to Roth each year prior to that. So Roth conversions are best usually for middle income people at the 24% bracket or below. There's a strong case to be made that if your top bracket is 24%, that you could convert money all the way until you get up to 28% because that's what the bracket's going to revert to in 2026. But if you're a lower income earner, there's a lot of opportunity to move small chunks over with paying very little taxes, moving to a Roth. the key is to spread it out over time. You would never do all this in 1 or 2 years. If you have 5 to 10 years to do Roth conversions, it's going to reduce your tax liability considerably. And you should be talking about this. You should be telling your friends about this, because taxes are going up. And if you can pay a lower rate today, why wait until tomorrow when you pay a higher rate? So here's some reasons to consider it. Tax brackets could rise, which we see that they likely are. Now, the chart I showed you with the ladder, that's happening in 2026, but the other proposals are on the table as early as next year. We don't know exactly what they're going to look like, but what I can say with confidence is it's likely that today's rates and tax brackets are going to be lower than what they're going to be in the future. So here's the benefits to converting to Roth. It lowers your overall taxable long-term income. You get tax-free compounding growth on your money. There are no required minimum distributions when you turn 72. And when you pass money on to your beneficiaries, all of it's tax-free as well. Another thing I'll mention is the income from a Roth does not count towards your Medicare premium increases. You know how those ratchet up at certain income levels. Roth IRA distributions do not count towards that number. So very, very good benefits to a Roth. It's like taxing the seed, and the harvest is tax-free once it's all withdrawn. So we're very big fans of the Roth IRA. Look at the goldfish bowl. You want to jump out of the traditional IRA bowl over into the Roth IRA with as much as you can. All right, so another thing to consider with all these new proposals, especially if they eliminate a step up in basis and these other things, is a family tax bracket management strategy. And I'm going to show you some other ways in just a few minutes as to how you can do that. But you have to look at not only yourself and your spouse if you're married, but what's going to happen to your children when they inherit assets. What is going to be the tax implication? What if they're already making $100,000 or more a year as a couple, and then they inherit $1 million IRA? They're going to have to take out at least $100,000 a year to get it out over a 10-year period. That's the maximum you can stretch a non-spousal IRA now. It's a 10-year period. So you really have to think beyond today. You have to think beyond you and your spouse. You have to look at, well, what if we don't spend these assets? What is going to be the impact on my family? So we do family tax bracket management. And it's going to be a focus more and more of ours in the coming years, because these things are not going away. They're likely to, the taxes are likely to increase, and the proposals are looking like they will. So we can coordinate anything we recommend with your tax preparer. You're not going to fly blind into this. We look very closely at what you can do, and we tell you as specifically as possible what your tax liability would be, and we ask you to confirm that and coordinate it with your tax preparer. So one thing you could consider doing that we recommend very often is, instead of taking your Social Security early at age 62, this is showing you early versus late claiming. So you should, more than likely if you're married, the higher income earner should wait till at least their full retirement age, which is typically 67 now, to take any money out of Social Security. You should pull what you need out of IRAs and spend that, and do Roth conversions if possible in addition to that. By deferring your Social Security, it gives you an opportunity to get money out of the IRA, and it increases your Social Security amount on a guaranteed basis. Every year you wait past your full retirement age, you get an 8% per year increase on your Social Security. So it gives you a higher guaranteed monthly income, and 15% of your Social Security benefit is always going to be tax-free. There's a maximum tax of 85% of it is taxable. So you'll always get at least 15% of that Social Security benefit tax-free. So we encourage you not to take Social Security as soon as you can, but look at, well, what if I drew some money out of my IRAs? It's going to reduce your tax liability and increase your guaranteed income to do so. So here's something you should definitely consider, and there's more than one way to look at doing this. In addition to Roth IRAs, overfunding a life insurance policy, maybe not on yourself, but maybe on a child, will give them the ability to have a tax-free income stream at your death. A tax-free income stream even before you pass away if it's on their life. So what you see here, this is kind of a complicated looking chart, but down below at the bottom left, you can see with life insurance, to buy the minimum cost, you could buy a term policy. That's not going to help you with tax planning. It will give you a tax-free death benefit if someone passed away. But what we're looking at is the maximum efficient contract. What's the most we can crank into a life insurance policy with it still being tax-free? If you go above that limit, it becomes taxable. It's called a MEC, Modified Endowment Contract. So we're looking to maximize the tax-free benefits of the life policy and minimize the cost of life insurance. One way of doing that is if you have children that you want to have a benefit for, if you want to help set them up with a tax-free income stream, you could actually insure their life and fund it with Roth IRA, IRA distributions. So you could say, well, I'm going to give my children the ability to have a tax-free income in retirement, and at the same time, I'm going to take money out of my IRA to do that. So there's ways to fund life policies on your children's lives if they qualify for it, of course. You also could take out insurance on your own life and give them a tax-free death benefit by doing so. But what we're doing here is playing within the rules of the tax code. Many members of Congress own exactly what I'm telling you about. This is no secret to them. It's been around since the 1920s, and they've gotten more and more efficient. So what we like the most is the top right of this chart, fixed index universal life. They have the potential to earn 7 to 8% a year. They're guaranteed against losses, and they can fund a tax-free income stream for your children, and or for you. If you're in your 40s, 50s, or early 60s, you also can look at doing this on yourself. But the lower the cost of the insurance on the life, the more money you can put in to grow your tax-free income. So this is something that you should consider, certainly for yourself or your children. If you're worried about tax increases, this is something that can really reduce those risks. So over to the far right again, we like the overfunded index universal life. Your principal's protected. You get competitive returns. All the boxes are checked except for they're not tax deductible. You get no tax deduction by putting them in there. If we look to the third column that says qualified 401k, you can see one of the boxes checked there is yes, you get a tax deduction, but when you pull money out of that 401k, you don't know what tax bracket you're going to be in until you take it out. So that's the only real upside other than tax deferred growth that comes along with the 401k. So the indexed universal life policy that we overfund checks many more boxes. And if it's appropriate for you, can really provide you with a tax efficient way to handle your assets and for your kids or your family or grandkids. So between the Roth IRA and the overfunding of the IULs, those are two of the best options you're going to find to help reduce your tax liability on income. So have we had any questions? Let's look over here into the chat box. Yes. Okay. I think Shana's answering most of the questions. But short-term gains are treated as income. So if you sell something less than 1 year, it's going to be treated as ordinary income. So whatever brackets you fall into, that's how short-term gains are taxed. So hopefully this has been helpful. In summary, let me just say that I do not believe every proposal that is on the table is going to pass. But what I'm confident in is they're likely to make taxes higher. The question is how they're going to do it. Once we know those specifics, we will make strategies to help offset those. And that is 100% within your right to do, is to follow the tax code, follow the laws on the books. You don't have to pay the maximum taxes. There's plenty of ways to follow the rules on the books to reduce your tax liability or adjust the timing of when you get income. So we certainly will help you do that. And hopefully this has been beneficial to you. If it has, please consider sharing this presentation with your friends. We're very willing and able to help them as well. So I hope everyone has a good Thursday and the rest of the week. And we hope to see you real soon. Take care.